Thanks, Jasper. Presenting Hemisphere Energy. My name is Don Simmons. I'm the president and CEO of Hemisphere. And Hemisphere is a small cap junior oil Canadian producer with most of our assets in southern Alberta. We've got a unique story where we look to increase production 10 to 20% a year. And we focus on shareholder return through a dividend and a share buyback program. So a little bit about our strategy at Hemisphere. I mean, we really are focused on like I said before, returning capital to shareholder and increasing value per share. It is a simple story. We have long life, high value oil assets, which provide us with years of sustainable cash flow. We've got a very strong balance sheet, probably the strongest it's ever been. We're currently debt-free, and we have very minimal wellbore and facility abandonment liabilities. So what that really means, without interest payments and without having to pay to clean up prior and old wells, we've got more cash left over to make acquisitions and return to shareholders. Very profitable. We have a very high net back barrel because we focus on oil. We have very low operating costs and royalties, so that really provides us with a high free cash flow yield. And what makes us so unique? Why do we have these qualities? Almost all of our production, 97% of our production, is under an enhanced oil recovery mechanisms and something called a polymer flood, which I'll talk about more in the presentation. But the key part of all that is it provides us with a very low decline rate and production decline rate. So that's key. If you take anything away from Hemisphere, that's what drives the company, and those are the type of assets we have. Those are the type of assets we look for. So high level production currently is about 3,800 barrels a day. As I said, we're an oil company. We're 99% heavy oil. The asset you can see on the slide is southern Alberta, an area called Atlee Buffalo. We have another area that we're testing currently this year called Marsden, just across the border on the Saskatchewan side. We trade on the Venture Exchange in Canada and on the OTCQX in the US. Share price is around $1.80, call it, per share. We have, for round numbers, about 100 million shares outstanding. And insiders, between management and directors, we own between kind of 15 and 20% of the company. So we're heavily invested in the company. Every decision that we make certainly has that in mind, and we are very aligned with the shareholders. So that gives us a couple numbers that we want to talk about, market cap and more importantly enterprise value, to compare to some of the cash flow values that we're going to see for the year, and also some of our reserve values. So with our cash in the bank of over $6 million at the end of Q3, we're sitting around call it a $165 million enterprise value. So that's a number I'll bring up a couple of times as we compare it to some of our other valuations. So this slide is gives a bit of the track record of Hemisphere, what we've done over the last number of years. You can see on the top left is production growth per share over the last 6 years, and you can see it's up and to the right. That's what you want. Continuing to build that production and methodically increase that production, and with that also increasing reserves and cash flow. The slide on the upper slide to the right is the reserve value per share, and again you can see over the last 6 years fairly consistently growing those reserve values. The bottom slide tells a bit more of the story. You go back 5-6 years, and we are a company that was much smaller and much less cash flow, and we had to take on a lot of debt in order to develop the assets that we had, and we knew we had significant value there. So you can see in red in the bars is debt, green is cash flow. As we grew cash flow, we were able to pay that debt down. In 2022, that was a big year, a big price spike with the Russia-Ukraine conflict. we were able to accelerate paying down our debt, and at that point in time, you see the new bar, the purple, which reflects dividends, and we started paying a dividend back then. So that's gives you a bit of a track record of where the company was and where we are today. So now we can start to look forward a little bit. This is our guidance for the year. Usually every January we put out our plans, at least our estimated plans, and some sensitivities on different price scenarios for the next 12 months. And so this year, price was around $75 WTI when we put this guidance out. That's what it's pegged on, but we have sensitivities there. What if price averages 65 for the year? What if price averages 85 for the year? We're looking to have average production for the year around 3,900 barrels a day. So that's about a 15% increase over 2024. And I'll talk to the 75 range. We're looking at about just over $50 million of adjusted funds flow or cash flow for the year. Capital expenditures, so drilling wells, land, seismic, we're looking to spend about $17 million. So that leaves us free cash flow of $34 million for the year, plus the cash that we exited the year with. And really the commitment that we look at of the base dividend, we pay a 2.5 cents per quarter. So that's about $10 million a year that would come out of that free cash flow. The rest of that free cash flow can be used for acquisitions, can be used for buying back shares, and can be used for special dividends, like we announced earlier today. If you look at that $50 million worth of cash flow for the year, and remember what we talked about us trading at around $165 million enterprise value. You can see we're trading a little bit over 3 times cash flow. So, in our business right now in the sector in Canada, we're seeing companies trade anywhere between, I'd say, 2 times and 5 times. So we're kind of in the middle or in the lower side of the middle. Historically, though, companies like us with a balance sheet that we have and a low decline, no reason why we shouldn't. And we certainly have in the past traded in that, I'd call it 5-6 times cash flow multiple. So we've been saying this for a while. We've been looking for the industry to start to see some of that multiple expansion. We really haven't seen it in the mid cap and the small caps, but I do believe that's something that we will see at some point in the future. Here's the reserve report. This is for the year ended December 31st, 2024. So I think we released this a few weeks ago. The focus that I generally look at when I'm evaluating other companies and either to invest in or to make acquisitions, really focus on their PDP reserves and their value and their proved reserves, the 1P. So in our case, over 9 million barrels of PDP. PDP stands for proved, developed, producing. So that's your production. If you didn't drill another well today and you just produced the wells you have, we would get another 9 million barrels, and the value of that discounted at 10% before taxes is $270 million. So significant value, more than where we're trading in the market today at that $165 million enterprise value. We talked in the past about how companies like us used to or typically traded in that sort of 5-6 times cash flow multiple. Interesting enough, that usually lines up with your proven reserve value. So in our case, $50 million of cash flow times 6 would be $300 million, and sure enough, that's where our proved valuation is on our reserve side. So 11 million barrels and just over $300 million worth of value. So again, you look at the chart down below, we're trading around that $1.80, value just based on the reserves, almost $2.80 a share for our blowdown, and over $3 a share for our proven reserves. So, and then how do we compare? Most companies now have their reserve values out, updated reserves. So again, this is, the one way. It doesn't matter what size we are. If you do it on a per barrel basis, it kind of, puts us all on equal playing field. You can see we've got one of the highest value barrels out there, on the right side of the graph. But then the next slide, let's look at how we trade, on reserve value versus our enterprise value. And as I pointed out, we're trading at a significant value to our PDP value, where we're seeing a lot of other companies are trading above or well above their PDP value, and in some cases even around their proved value. So certainly don't think we're overvalued at our current valuation in the market. So now we'll get into more the pools themselves. Don't get terribly technical. Like, these are pools that we really focus on a larger scale. We don't really get into well by well numbers. We really look at these as a project, an enhanced oil recovery project on a pool basis. So again, 97% of our production comes out of the Atlee Buffalo area. This is the engine of the company. This is the cash cow of the company, and this is really, we use the capital and the cash flow, from this production here to pay our dividends and to go out and grow the company and test other new areas that could be significant increases of production and cash flow. We own these assets 100%. We operate these assets. These are high value assets that we've implemented these floods to maximize the amount of oil we get out of them and to minimize the decline rate, so it's as predictable as possible. The one point I made, I talk about it being a cash flow harvest mode here. We've got about 11 million barrels of proven reserves to take out of these two pools still, but very minimal capital. $25-26 million worth of capital required to get the rest of those barrels. So this will be a key part of our company for years to come. So a little bit on polymer flood. It's not Hemisphere proprietary data or infrastructure or anything like that. These are really this is a method that's been used for probably more than 70 years in the business. It's a way that all we're doing is adding this polymer to our water injection and to our water to increase the viscosity of the water. So it makes it more like a consistency of olive oil. And what that does is, when we inject that to keep the pressure up in the reservoir and push some of this oil around, if it's just water, it'll find the pathway of least resistance, and it'll streak through the reservoir, and you'll leave some of that oil behind. And so by increasing that viscosity, we're able to capture more of that oil, push more of that oil over to our producing wells. So if you look at the diagram, there's the surface, the farmer's field. We've got our pad where we've drilled our horizontal wells. You can see 3 horizontal wells drilled into the oil reservoir. We inject our water and polymer into the middle, and we push that oil to either of our producers on either side. So what do we look for in a successful polymer flood? 1 is increase in oil production. 2 is a decrease in the decline rate, and I've talked about how important that is. I'll show that on some slides on what that means to cash flow. And but ultimately, what's amazing about these kind of projects is we already know all this oil's here, and so it's not like there's exploration risk in order to find more oil. The risk comes in is how effective is this method. And if you know all this oil's here and you can add something and add a little bit of cost to your operating costs and a little bit of capital for your infrastructure, but increase your recovery of oil you already know, and you already have facilities and you already have the wells, it's extremely economic. And then the last benefit is we get a decrease in water production for a number of years, so you have less costs in handling that water. So how do we know it's working? That was the one thing. I mean, we had a successful pool here. We were developing with horizontal wells and with a water flood. But how do you know that the polymer is working? How are we seeing all those attributes I just talked about in the slide previous? And so what we did is once we had this these polymer floods up and going for a period of time, we could look back. And this slide, there's a lot of information tucked into here, but the green is production. The black dashed dots are number of wells that are producing. And then we've highlighted, when did we start our water flood? When did we start the polymer flood in the G pool? And when did we start the polymer flood in the F pool? And we took basically 40 wells that we drilled between 2014 and 2019. So a number of years before we started the polymer flood. We took those wells and we looked at them, how they reacted through time after we started the polymer flood. And you can see those same wells, 40 wells, of course, half of them now have been turned into injection wells, not producers. Our production from those wells, even 4 years after we stopped adding wells, are producing more today than they were after they were drilled. So that is telling us that we have a very successful polymer flood here. Some of these wells have been on production for 10 years and are producing as much or more today than they were when they first came on. So that is the benefit and basically the background data that shows us that that this polymer flood is working very well. So this is an interesting slide. This is sort of comparing that data we just looked at in Hemisphere's decline rate, corporate decline rate, and what a typical oil and gas company's decline rate looks like, and then a bit of discussion on it. And so the top graph, like I said, this is a typical oil and gas company. There's nothing wrong with these companies. They make lots of money. And this is just physics. This is the way the oil and gas business works. You drill a bunch of wells, you add a bunch of production, and those same wells, a number of years later, are generally producing much less oil. Doesn't mean they didn't make money. Doesn't mean they still don't make money. It just means that you've got to continue to spend money in order to stay flat because of that decline rate. And a typical decline rate, small cap, mid cap company is in the order of 20 to 30% production declines per year. So you can see what that looks like. Every single one of those different shades on that upper graph represent a year worth of drilling, a year worth of production adds, and then you can follow that wedge on where those wells are producing a number of years later. So if we look down at the bottom graph, though, this is Hemisphere's production profile and our decline rates. So you can see that, as we've added production, the production wedges either grow or even stay relatively flat over years of production. So that is a huge benefit to our company. It's a huge benefit to our cash flow because what it means is that we need to spend much less money to stay flat. So money that we do invest in development means that we're typically adding production. And so, to put it in cash flow words, there's a comment there that a company with a 5% decline rate will generate as much cash flow in 4 years as could be generated in 9 years with a 25% decline. So that's very significant difference in cash flow. And then here's the new area. Again, it's called Marsden. This is some land we picked up a couple of years ago. Last year, we drilled 5 wells. So we drilled 3 producing wells, 2 injectors. We built some facilities through the summer. And then we started our injection sometime late in the third quarter of last year. So we've started injecting. We're building the pressure up. Again, this is an old pool that was developed back in the 80s and the 90s with vertical wells. So they took out some of the oil. So we know there's oil there. The question really is, can we come back into this pool, drill horizontal wells, inject polymer and our water and polymer to build the pressure back up, push this oil over, and what kind of rates do we get? So there's only one way to find that out. You can model it and guesstimate and look at analogs, but there's no real way to know for sure what kind of economics you have until you spend some money and test it with a pilot project. So that is what we're doing in Marsden right now. We're to give you a sense of timing. I think in Atlee, in the G pool, we had to inject for at least 12 months before we had enough pressure built back up in the reservoir in order to start producing some wells there. So, we're maybe 5 or 6 months into injecting into Marsden. So we expect ourselves to that we're going to need to inject for at least that much more time go forward before we start to see real kind of production responses from these assets. Once we see those responses or no response, then we'll be able to run economics. Is this a project that we can scale up and add significant production from, or not? So that is a test that's ongoing through 2025. Okay, let's talk a little bit about our return of capital, how we do it for shareholders. One is our base dividend. So we do a quarterly dividend, 2.5 cents a share. So we've paid out over $30 million since we started that. Gives us an implied yield of around 5 to 6%. And the last dividend we paid was in February of this year. We also do special dividends. We just happened to announce one this morning. It isn't on here. We haven't. We're just updating the presentation here today to update the website. But we have now paid out, I guess, almost close to $12 million since we started dividends. Specials, I like to tell shareholders, they are special. There's no, method really to it. What we generally do as a company and as a board is look at, where's the market today? How was the quarter we just had? Was it operationally the way we expected? Was it financially the way we expected? What do we have plans for in the next quarter? Do we have acquisitions we're looking at? Do we have anything, coming down that was unexpected from guidance, either good or bad? And make some decisions based on that. So in this case, it's just another form of returning some of that capital to our shareholder base. The last thing is the normal course issuer bid or the share buyback program. Again, it's more strategic and opportunistic. We don't have a daily set rate or a monthly set rate. We tend to take advantage of the market on days where, sometimes oil drops significantly. I mean, oil dropped $5 today. So I wouldn't be surprised if we ended up buying some stock in the market today. And, we have a certain limit we can buy within a 30-day period and a limit within a 12-month period. We will continue to pick away in the market there. So I think year to date, we've bought, over 700,000 shares. And since we've started the program back in 2019, we've purchased and canceled over 13 million shares. So it's a nice way to add, again, just to add some value for our shareholders. Little highlights on the bottom there. We've now, if I look just at 2024 last year, including all of the specials and the base dividend and the buyback, we returned over $21 million to shareholders for about almost a 12% annualized yield. So a very good year last year. And in total, you can see on the other bar, we've returned almost 54. I guess including today's announcement, probably close to $55-56 million to shareholders. Yeah, so this is really the wrap up. The last slide, just sort of highlighting what makes us such a unique story. Certainly our high free funds flow yield. Again, why do we have that? I can't stress it enough. It really is the type of assets we have, the way we're able to develop them, giving us that very low production decline. Balance sheet is in a great position. So we're currently with no debt. We have positive cash position on the balance sheet. We're and very low wellbore liability, decommissioning liabilities. We've got a new play I talked about that we're testing. So we'll get some guidance and some understanding of that as we move through 2025. And we are very focused on adding value and paying our shareholders that return of capital as we look for other opportunities to add significant value to the share price as well. And that's really it as a summary. That's Hemisphere.
So thank you for an excellent presentation, Don. So could you just quickly describe, who are you, and tell us about your career?
Okay, yeah, well, I'm a geologist by training, and I've been in the oil and gas business now for I guess almost 25 years. So I've seen a few ups and downs, a few cycles. I trained at a larger company, so it was a great place to learn the business and get a lot of experience. And then for the last probably the second half of my career, I've spent at smaller companies, and Hemisphere is the latest. So it's an interesting, exciting, dynamic industry to be in, and yeah, it's generally a lot of fun. I mean, days like today, I'm not sure you're aware of tariffs being announced around the world, and oil dropping $5, but this is it's all part of the business we're in, and you got to build companies that can withstand these ups and downs, and maybe even take advantage of these type of opportunities to go out and buy an asset or buy a company that may not have the same balance sheet or opportunities that we do.
So, could you recap the last hour? Recap 2024 and the first 3 months of this year.
Yeah, 2024 was a really good year. I mean, we did see some challenges, I'd say, with some weather. Early on in the year, it was a really cold start to the year. So we saw some operational challenges there, but we made up for that, very well through the rest of the year. So in the end, we were bang on, or even a little bit above what we had planned or guided for the year, and as well on the financial side, a really good year overall. So coming into 2025 in a nice strong position. Again, production growing through last year into 2025, and we haven't done a lot. Like a lot of our capital spending and our activity in the field, we generally do in the summer. So when we look at Q1, again an overall good quarter. Production we put out to the market kind of as expected. And we saw a pricing environment that was pretty much as expected. It's not always follows the WTI we predict, but we certainly saw in our case the differential was quite good, the WCS, and the dollar in Canada has been weak, which is a benefit for Canadian oil producers. So overall, again, another solid quarter behind us, and now we're heading into Q2 and gearing up for our drill program this summer.
So, I mean, the US has imposed 10% tariffs on Canadian energy. So, how is that impacting Hemisphere and primarily the realized the oil price?
Yeah, I mean, so there's been a lot of announcements. It's probably very confusing for shareholders to follow and to understand. But I think it's important to let everyone know that as of today, a company like Hemisphere, who is compliant under whether we call it the USCA agreement or the CUSMA agreement, we call it in Canada. If you're compliant under that, you are exempt from any tariffs. So I know Hemisphere, and I'm sure most Canadian oil producers would be exempt from any of those tariffs today. That could change tomorrow, but as we sit today, and with the announcements even yesterday, April 2nd, that nothing has changed on that. We still are not affected by any U.S. tariffs on energy.
How has the WCS spread been affected by it, and what is expected to average this year?
Yeah, I mean, it's been very interesting. So if in our opinion, in our assessment, if a tariff was implemented on Canadian oil, then one of the mechanisms that it would be applied to Canadian producers, because Canadian producers don't pay the tariff, right? It's paid by the buyers of the oil. So it's paid. The tariff is paid for by the refineries in the U.S. that buy Canadian oil. It's not like Hemisphere pays a tariff. It's the refinery pays the tariff. So the refinery has a choice. Do they pass that tariff cost to the consumer on gasoline prices and diesel prices and jet fuel prices and asphalt prices and chemical prices and all these different things? Or do they try and push it back to the producer Hemisphere. And so the only way they can really push it back to us is to say, well, we're going to pay less for your oil, therefore, we're going to have a slightly wider differential. And so, that was a possibility that we might see in the market. We have not seen that. We saw it maybe in January around the discussions of tariffs, but the reality of the oil business is much different than the discussions. And what we're seeing is a lot of heavy oil barrels have been taken off the market or threatened to be taken off the market. So we've actually seen the differential narrow to one of the lowest numbers we've seen in quite a while. It's currently trading around $9 US. So significantly better than we even expected for the year. I think our guidance, we were expecting around $14 US average for the year. So, that can change tomorrow, but today we're currently seeing a much better Canadian price than we anticipated.
That's an exceptionally good price or differential.
Yeah, and again, it part of it is this time of year, so you're ramping up for the driving season. We have some refinery maintenance. We have spring breakup in Canada right now, which is affecting some of the oil sands producers. So, there's some reasons non-tariff related to see this differential narrowing. But we'll take it. That's great.
Let's talk about your reserves. So you have released your reserves. You have 14.5 million as you showcased in 2P reserves, and then which is about a 10-year reserve life at 300 at your current guidance of 3,900 barrels of oil per day, or oil equivalent per day, I guess I would say. But could you give us an overview of your reserves that you released this year and compare them to last year? And also, if you could tell us how much is from Atlee Buffalo, Jenner, and Marsden.
Sure. Yeah. So, the reserves, you broke up a little bit there, but I think I got the gist of it. So reserve values, this year, PDP was up, proven was down a little bit, 2P was down a little bit, really a function of our production and depletion. Plus we sold a few things through the year, some assets that we had reserves associated with, but we're not going to drill those wells. And so we took advantage. There was a companies active in those areas, so we sold them some of those assets and some of those lands with those reserves. But the PDP being up, that's a function of our production going up. So we're basically taking 1P and 2P reserves and putting them into the PDP category. As far as where are our reserves, mostly Atlee is the bulk of our reserves. It's the bulk of our production cash flow. So I would say 95% or close to it would all be in the Atlee area. Jenner is a very small area for us. I think we're maybe 100 BOEs a day there. It's not an area we've focused on for the last number of years. And Marsden is in test mode, right? So it's it's just the pilot, and we have to prove the economics. And in order to prove that, we need to see the results, and then we could show those to the reserve auditor, and we can get an assessment on what the future value could be.
But for Atlee, do you get full credit for your polymer flooding, or is there a difference between you and what you projecting a recovery factor?
No, I think we've proven over the last number of years that the polymer flood is extremely effective. So a lot of that is in the reserves. Can there be more? Sure. I think we just need to continue to show year after year that you're producing and the reservoir is performing as you predicted. The more comfortable that the reserve auditors get with seeing that, then they could inch up a bit more. But I think we're reasonably happy with the reserves we have booked in Atlee.
You're guiding for 3,900 barrels of oil equivalent per day this year. How will the production vary over the quarters?
Well, we should start because we haven't drilled anything since last summer. I think we're sort of expecting in that 3,800 BOEs a day for the first half of the year, and then as we start to drill some wells, bring on some new production, through the second half of the year. We should see that raise up, hopefully over 4,000 barrels a day to get us into that average of 3,900. So, that's typically the way our years go. Is we're fairly quiet through the first half, and then a lot of production comes on. I'd say kind of August, September, October is when we're generally bringing a lot of those wells on.
And how much have you assumed to come from Marsden, and how much from Atlee?
I don't think we have a lot baked in from Marsden, just because we really don't know, and we don't want to plan for production increases if we don't see any there. That'll be, if we do see that, then we'll plan for that. In the future, but I would say the bulk of our production adds this year will be, and our current production from our base is Atlee. We do have some drilling planned in Marsden on a different play, and we might have a little bit of production planned towards the end of the year, but we're not planning to drill those wells to probably later in Q3.
Atlee's almost at 4,000 BOE per day. Do you see that as is that the ceiling? What Atlee's capable, or could it get above 4,000 in the future?
I don't think we're at the ceiling yet. We still have more wells to drill there. We've got other ideas to test there, and we're still converting parts of these pools to injection and expanding the polymer flood, which in theory should help us increase some production in some of those areas. We're not going to see the dramatic increase in production that we've seen there over the last 4 or 5 years again, but yeah, I think we've got room there with success to get up over 4,000 for sure.
Could you break down the 17 million capex budget for us?
Yeah, I think we've got planned there about 8 or 9 wells planned with that, with the remainder being a mix of some pipeline work that we'll need for the wells that are being drilled. A little bit of facility work this year, not a whole lot planned, but we like to have some budgeted just in case something comes up through the year where we see a facility requirement. And then the rest would be rounded into land acquisitions, land sales, seismic acquisition, some geology stuff, more on these type of new opportunities that we're always looking at and trying to capture if we can.
So this includes more than just Marsden, I assume, when you talk about land acquisitions and potential drilling and exploration well.
For land, we're always looking all over, all over Western Canada anyway. I'd say Alberta and Saskatchewan. We're that's part of what we do, is look for additional opportunities to pick up land positions on things that we think we could squeeze out a bunch more oil.
How does the royalty rate and also income tax per barrel vary if you go to between sort of $70 to $80 per barrel WTI?
So again, it's not just tied to WTI. It would be tied to the differential, WCS, dollar, all these kind of things, exchange rate. But I mean, in that range, you're talking about between 70 and 85 or whatever. I mean, you're not going to see a dramatic change in that. I mean, down at $70 oil, you might have a 17 or 18% crown royalty, and at 80, 85, you might have a 22 or 23% crown royalty. So not a dramatic change there. If you get some really wild swings, like oil down to $50 or something, then you see the royalty rate significantly come down, and it can get down. I mean, I've seen, unfortunately in my career, seen some low oil prices where the crown royalty goes to almost zero. I mean, a couple percent type thing, right? And then, you get events where, we saw the Russia-Ukraine conflict and we saw oil spike up into, whatever it was, 120, 130. So we saw some months there where our crown royalty rate probably crept up to 25% type thing, right? So in that range you're talking about, those 70 to 80, 85, you're not going to see a big change in percentage there. And then tax is more of a function of where, what corporate tax pools we have, how much our capex is. I think we see anywhere, the corporate tax rate in Alberta would be around 24%, I think, total, but we'd still have tax pools and we still continue to create tax pools. So I think on average, we're somewhere in the 15 to 20% range, this year and go forward for a few years.
So your OPEX, including transportation, which is good, is at around $15 per barrel guided this year. What measures are you taking to maintain or lower your costs?
Well, I mean, the guys are always looking for ways to lower costs. I would have to say, I mean, our operating costs for a heavy oil producer are extremely good. And some of the things that we've added costs on is certainly the polymer over the last couple of years and the cost of the polymer. But that's added significant value and production and cash flow. So, what are we, there's nothing, no magic or silver bullet where, we can look and say, hey, we can shave off another dollar or two here. I think the biggest thing we've looked at as we've gone through last year and how could we get a lower per barrel operating cost is really maximizing our uptime and on time of production. So having some backup in cold weather, or some little piece of equipment goes down that causes you have to shut down the battery for 6 hours, costs you money and costs you barrels. So is there something we can have in place for that particular thing that doesn't cost a lot of money to have a backup on hand or already built in? So those are some of the things we look at. So that's but I don't expect any big magic bullets to change op cost significantly.
Marsden, what does success look like?
Success is having economic wells. So I don't have a specific number really, because this is it's not just drilling wells. You have to drill wells to inject in. You have to have facilities, pipelines. I mean, there's all these things. So what we really are looking to determine from the pilot project is, if we invest in drilling these wells and we get a rate after building the pressure back up and moving some oil around in the reservoir, what stabilized rates do we get, and can we expect those rates for a number of years? Then we can run real numbers, right? And we can say, okay, well, at $70 oil, we get a rate of return of this, and how does that rate of return on that capital invested compare to other projects that we have or we like or we're working on? And then we can make a decision to go forward and say, you know what, this is a project we that has positive economics that we're going to scale up, and then we'll start to dedicate capital there, or not. If it doesn't make hurdles, if it's uneconomic, it's pretty easy decision to make. If it's economic, but other things that we see look better, then those other projects are going to get the capital.
When will you internally know? Do you think, if you give us a range, when you internally will know if you will go ahead or if it's probably not no-go?
Well, we won't internally know until we see what we think would be a response from the flood and from the pilot. And, we know just from analogs and from other things we've worked on and some modeling, as I mentioned before, I mean, it took 12 months in Atlee, in the G pool, to build that pressure and up enough in the reservoir in order to start to get some production rates. So, we're using that as a guide and saying, okay, well, 12 months will be late in Q3 2025. Hopefully we've seen something by then that we can start to run some real numbers on, run it internally, and then we can go from there.
And how quickly will you let the market know when you know?
Oh, I mean, we give updates fairly regularly. So yeah, I mean, we'll update once we know what we're going to do.
Perfect. Is there anything you could tell us in terms of oil quality, or what differences and similarities you see to Atlee Buffalo in terms of Marsden?
Yeah, there's similarities, and then there's some subtle differences. I think what we look for polymer flood projects is sort of a range of oil quality, a range of porosity and permeabilities, and then obviously there's a play type that has to be a certain type. And what I mean is, has to be oil, not a bunch of water, or oil over water, or a lot of gas, or anything like that, because that will impact the effectiveness of a polymer flood. So Marsden is got the right oil quality in the range we're looking for. It has the right play type. It has the right, we're within the range of porosity and permeabilities we're looking for. But you just don't. That's great. That's the land you want to acquire and pick up. And we know there's oil there. We know that they've produced oil out of the verticals back in the 80s, 90s, 2000s. So what we don't know is, if we drill horizontals and we inject in this polymer and we build the pressure back up, what kind of rates are we going to get? And that's what we're determining with the pilot project.
I mean, now, not to go ahead of an event here, but say that polymer works. What could be the size of the prize for Marsden?
Well, we don't own all of the pool. I think the original pool, delineated by the verticals and assessed by the Saskatchewan government, I think they allocate somewhere in the 180 to 200 million barrels of oil in place. So it's a very significant pool. We don't have all the land on that, but we see this as an opportunity, like a meaningful opportunity. That's what we look for to assess. So, could this thing be like an F pool for us and around 1,000 barrels a day? That's possible. That's what, those are the type of projects we're looking for. Something that's got some running room, some scalability, and something that we can add some significant production with. So yeah, that's sort of what we look at the prize there.
And I mean, right now you have exceptionally low arrows, 7 million recorded on the balance sheet. How would your asset retirement obligation change if you actually go ahead and develop Marsden?
Oh, it wouldn't be significantly impacted. I mean, ARO generally creeps up significantly when you acquire assets that have a whole bunch of suspended wellbores or wellbores that haven't been reclaimed and abandoned. So with Marsden, we're not, that I'm aware of, looking at any acquisitions that would come with a whole bunch of wellbore liabilities. So I don't see us, changing our ARO significantly in Marsden. You'll add some. Obviously, every well you drill has some future abandonment liability to it. But with a new well, that abandonment, I mean, if they're going to produce for 20 or 30 years, that abandonment is so far down the road that it's fairly minimal in today's discounted rates, right?
As you mentioned, the Canadian dollar is quite weak. Historically, it's very weak. I mean, one USD is worth 1.4, 1.42 Canadian dollars. Are you putting any currency hedges in place at these levels?
No, we don't. We don't put any currency hedges in specifically, but we will in some of our hedging. Whether it's in WTI hedges or whether it's in the WCS diff hedges, we may either do those in Canadian dollars or US dollars, depending on where we think the currency could be going, right? Weaker or stronger. That's the only way we would sort of play a type of hedge, I guess, on currency.
And could you explain your hedging program? You have no physical hedges, just a few small portion of your production hedged through put spreads and collars.
Yeah, I mean, hedging is something we look at on a weekly basis at minimum, but the hedges in place are mostly a function of our requirement for our banking and for our lending. And so in order to have access to a $35 million credit facility with our bank, we are required to have 5% of our production hedged. Now, those hedges are quite flexible, so typically we don't, depending on where the market is, but in a lower price environment, we'll typically just buy floors. In a market where we see the price a little higher, we might do collars. So it's a costless collar. It doesn't cost us anything. But we're mostly looking to be careful of not limiting our upside in with the current balance sheet, as opposed to really locking in specific cash flows or anything. So that's our current hedging strategy. Now that would change. If we did take on debt in order to make a big acquisition or something like that, our hedging strategy would probably tighten up significantly.
What's the maintenance capex ballpark if you want to sustain production at the current levels? 3.8, 3.9 thousand barrels per day.
Maintenance capital per year, you mean? Or
Yeah, like sustain production, not grow it. Yeah, and include some for facility upgrades.
Probably in $4 or $5 million a year. You should be able to kind of maintain that for the next few years. And again, that goes back to the low decline, right? That's the low decline rate is extremely helpful with that, with the polymer flood.
To what level would you say that your base dividend, which is it's a paid every quarter, but it's 10 cents a year, is sustainable, comfortably sustainable?
I never answer these questions because there's too many variables, and as a small oil company, I mean, I tell people, you tell me what the price of oil will be for the next number of years, and then I can tell you what our dividend policy will be. But obviously, I mean, it's there. It was put in at a level that we felt we could sustain through a lot of cycles, up and downs, and then offset it with the special if things are better. But I mean, there's so many things. I mean, WTI could drop, but differentials narrow, and the dollar goes, the Canadian dollar goes down, and we still make a bunch of money, right? So it really, it really does depend. I mean, if oil's dropping significantly, you got to look at yourself and say, well, why, and what's happening, and how long do you think it's going to stay low, and are there structural changes to the entire world, or is this sort of a short-term thing or a long-term thing? So, I mean, that's my answer to not really answer. I don't have a specific oil price number or anything like that. I mean, you can look at our guidance and see that cash flow is protected down. You can run it fairly generally. Every $10 of WTI goes down at the same dollar and diff, you lose about $10 million a year. So, that gives you a pretty good sense of how far you could go on WTI before you start to get concerned.
So, I mean, you explained your use of the buyback program quite well. But today you just announced a special dividend, 3 cents a share. These special dividends have become quite frequent in the past years, in the most recent years, really. Could you explain again what your process looks like if you decide to pay out a special dividend or not?
Yeah, again, I mean, as I said before, we were going through the presentation. I tell shareholders special dividends are special. It's something that we look at. I'd say on a quarterly basis, we'll look. How is operations in the field? How was the financial side of it? How was the price of oil? How was the diff? How was the dollar? What does it look like in the next quarter going forward, or the next half a year? Do we have an acquisition, that we're really thinking we may do that could stretch the balance sheet, and we want to keep that money in order to pay something off? Is the market seeing a lot of selling pressure, and that money would be better spent buying shares in the market? I mean, there's so many variables. There's no specific process. It's just trying to apply, I'd say, common sense to the market at that given time, and trying to look at a common sense approach to the market go forward, and what's the best use of that money. I'd love to say, hey, I'm going to take your money, I'm going to invest it, and I'm going to double it. If I don't have a project in front of me that I see making an acquisition that does that, then you take your money and you find something in the market that can double or triple or 10 bagger, and go for it. And so that's sort of our approach at a high level, and it really does vary from quarter to quarter and year to year.
So could you give us an update on the status of the Canadian M&A market for oil and gas?
It's challenged. I think just with so much uncertainty over the last number of months, we've seen some big deals. We saw the Whitecap and the Variance merger, which was a big deal. We've seen a few other smaller deals, I guess, but for the most part, I think there's still a big disconnect between buyers and sellers on, the sellers feel that they're worth a lot of money and the buyers are not willing to pay a lot of money right now. So, at $70, $75 oil, the sellers probably will dig their heels in. At $60, $65 oil, they might be a bit more realistic, and depending on their situation and depending how much pressure they're getting from shareholders, they may get pushed to do a deal. So we're in a market where there's people want to do deals, but we're not seeing a whole lot of deals.
You have said in the past, I mean, you're looking at everything as long as you're looking for molecules that make money, but you're better. You obviously have an advantage with polymer flooding, or certain. Well, at least I would at least advocate for that. What target profiles, what type of assets attract you?
Well, yeah, I mean, we do look at a lot of stuff, and I mean, we in general we do typically target oil over natural gas, just because natural gas pricing has been very challenged for a long time. So oil's an easier thing to make money with. So we do focus more on oil than gas. We really like low decline type assets because we see the advantage of it. So looking for water flood type opportunities or polymer flood type opportunities. But it doesn't have to be that. There are projects out there under primary production where you can make a lot of money. And so if the right size of opportunity came up that wasn't, enhanced oil recovery or a water flood, we look at those as well. I mean, it's just, we're picky, right? We don't want to take on too many wellbore liabilities. And if we are, the upside has to be there. And at heart, we're drillers. We like to, if it's not drilling, then have some sort of project like a flood, a polymer or water flood where we can add significant value per share. And, I think in general, we know that there's no difference between 4,000 barrels a day, 10,000 barrels a day, probably even 20,000 barrels a day as far as the market goes. So we're not getting bigger. We don't see any reason to get bigger for the sense of just having a bigger number. We want to get bigger to make more cash flow and to make more cash flow per share and to add significant value per share. And you don't necessarily have to buy things to add value. Sometimes you can buy things and it can go horribly wrong, and you can have less value at the end of the day. So yeah, it's a wide range though. I like to look at everything, and it's easier to look and say no than it is to not look and miss something.
Could you explain how's your access to debt and equity, and what kind of size could you potentially look at on the sort of higher end?
Well, I mean, we currently have access to a $35 million credit facility, so we can move pretty quickly on anything in that range. Plus, I guess, the cash that we have. But our reserve report, our lending power with our proven reserves is quite significant. I mean, we could probably lend or borrow something up in the order of closer to 70 or 80 or $90 million. Now, whether you want to stretch the balance sheet to that level in this market is a different story. But we certainly have the lending ability with the reserve report that we have. And then as far as the equity markets, tough. I mean, you wouldn't be able to raise much money today, I don't think. And oil down $5 and everything red, it'd be a pretty tough sell. I think we have built a good track record for around the right deal. We could raise some equity, I believe, in the market, but it's tough for small companies.
But so then, to my ultimate question, where do you envision Hemisphere Energy in 2 years from now?
In a few years. Well, I get asked this quite a bit. I think I've landed on really there's three scenarios. Whether one is we continue to do what we're doing, growing that 10 to 20% a year organically, and continue to build the company and build value. That's one scenario. Second scenario would be we're even bigger. We do add on an acquisition that we were very excited about, and it does add barrels and reserves and cash flow. And three is we don't exist anymore. We've been bought out by a company that's bigger than us, that wants the free cash flow, that is very attracted to the reserve life, the low decline rate, and we've been rolled into something else. I'd say those are probably the three different scenarios that I see down the road.